Now, in other news, a lot of the super investors have started reporting their 13F filings. So I thought this video we could go through some of the major super investors, the ones that align with my strategies and those who do not, and go through their new activity and if they're still holding their positions or selling out of them. So with that, let's get into it. If you like this content, please like and subscribe, and let's get into this video about super investors. So the first super investor that I want to cover is Chris Hone with his TCI Fund Management group. And he just reported his activity for his stock portfolio. And here you can see a few changes. He added 47.15% to Visa, and now that represents 18.18% of his portfolio. And then he reduced Microsoft by 5.54%. MCO, which is Moody's Corp, added 0.46%. It was very negligible. SPGI, he added a little bit. And he reduced a lot of other ones. The biggest thing here, the biggest two things that I want to point out in this portfolio are the Visa change, where he added 47%. And then Google, he reduced by 41.41%. And I'm not sure if I agree with these actions. Google seems to be a winner. We can't tell where he actually sold his Google. And if you go to the sells tab on Dataroma, you can see that he sold completely out of Google, which is the Class A shares of Google, the voting shares. And then he reduced his Class C shares, Goog, to about 41%. So that's a huge change and not something that I agree with. I think Google has so much going for it. Yes, it has risen a lot in the past few months, from the 140s and 150s now to over more than double. It's close to 300, or has been close to 300. But there's a reason for that. It was very undervalued at the time when it was 140 and 150. Then we got some legal clarity with the case being dropped, the antitrust case being dropped on them, and them being allowed to keep Chrome. But after that, why would you sell? Why would you sell this strong name after they've beaten that antitrust litigation? It doesn't make any sense. So they have Waymo, they have YouTube, they have GCP, they have Quantum. They have so many things that are working for them. This is the first time in a long time where this overhang of this case against them fighting ChatGPT in their competition with search, that's all almost resolved. Now Google is the winner, I would say, in that space. They have had search for years and years and years, and they have successfully integrated AI mode, AI overviews, and Gemini into their search products. So their revenue streams will stay strong regardless. There's going to be no disruption to their search revenue. And they've made sure of that. They've spent so much time and money and energy in integrating AI into their search that it cannot be disrupted by ChatGPT anymore. There's nothing that ChatGPT can offer. They can make a search, they can make a web browser, but it's not going to be able to compete with Google. They'll have their own users, but people will still be using Google search. So it's strange to me that he chose to sell out of 100% of Google L and then 41% of Goog shares. That's not something I agree with, and I don't think that's going to be, I think that's going to be a regret in the future. For the other play for Visa is a strong compounder. I think that's a company that will do well. I don't think it's going to do better than Google. Absolutely. I don't think it's going to do better than Google going forward, but maybe he felt that Google and all the other tech plays are a little bit overstretched. He also sold a little bit of Microsoft. So maybe he feels there's an overvaluation in the tech space and he wants to go into more, conservative financial plays, traditional financial plays that will preserve the money. So one of the big things for a hedge fund or a super investor to watch out for is to preserve capital because they're managing other people's money. So number one should be conservatism and preserving the capital so that you can play in tomorrow's game. So that could be what's happening here, but I definitely don't agree with the selling Google shares in this portfolio. That would have been a strong play, especially with the dividend and the share buybacks and just the revenue increasing. And we saw how strong the Q3 2025 results were. So that's not something I agree with. Okay, let's move on to the next super investor. So here is David Tepper's Appaloosa management portfolio for Q3 2025. He has a bunch of stocks, and this is not something that I do. So this is one of the super investors that doesn't invest like I do, where they have a slew of stocks and companies that they invest in. I tend to prefer more concentrated plays and high conviction concentration for my stock portfolio. But here you can see there's a lot of companies that I do agree with. He has Alibaba. I do believe in Alibaba's long-term growth potential and investment potential. He has Amazon, Whirlpool, Nvidia, Google. Looking at the activity on these names, that's something I don't agree with. So he reduced Alibaba 8.73%. He reduced Amazon by 7.41%. Interestingly, he increased his Whirlpool Corporation shares by 1,966%. So he added 5.5 million shares to his existing position in Whirlpool. So this tracks with what Chris Hone was doing in his fund, where they're moving away from tech. All these super investors seem to be moving away from tech and going into more value plays. They're doing a rotation from high tech to traditional value and retail value. He did add into Nvidia, so he still believes that there's some possibilities in the chip space. Added 8.57% to Nvidia, reduced Google by 7.5%. This is the Crane Shares China ETF, KWEB. He added 85% there. So he might be seeing, it's interesting because he added here and then reduced a Chinese holding in Alibaba. But maybe he's trying to get a bigger basket of Chinese equities so he can play the field rather than just a single name. He added to Taiwan Semiconductor. So yeah, he's playing the semiconductor space and a broad basket of Chinese equities. He reduced energy. He reduced Meta, which tracks, it's a US tech company. Vistra, he reduced. Pinduoduo, he reduced. So again, playing that. Reduced Uber and reduced JD and reduced Microsoft. He did add to Baidu. So maybe he's seeing a specific thing with Baidu where he likes that and wants to play that. He added a lot to Qualcomm and a lot to AMD. He actually made a new position in AMD. So broadly speaking, the themes I see in David Tepper's portfolio is he's adding to non-tech plays like Whirlpool and Fiserv and American Airlines through his financial group. And he's reducing US-based tech companies like Amazon, Google, like Microsoft, like Meta. He's reducing those potentially because he thinks those are overvalued at the moment before this great drop that we've had right now. But he does believe in a broad basket of Chinese equity by buying this KWEB equities basket. And also he believes in semiconductors because he's buying TSM, Qualcomm, Nvidia, AMD. So he's in the semiconductor space and he believes strongly in those. Okay, so let's move on to the next super investor in Chuck Akre. Now for Chuck Akre, I see one major change that really caught my eye and is why I wanted to cover him is the change in FICO, in Fair Isaac Corp. He added 2,751% in FICO, which is a very big percentage change in the portfolio. So he added 260,849 shares of FICO. And the only thing I can think of here is, let me look at the buys and look at his, so let me look at his average cost here. So yeah, he bought that at a much lower price in the quarter at $14.96. And right now it's already up to $17.48 and probably will go up into the future. So he's already making about 16.83% on it. I'm wondering if he's going to keep these. We'll have to see in the next 13F if he's going to keep these shares, because it's already appreciated a lot compared to his other holdings. So I want to see what his next 13F looks like. It might be that he's sold out of this. That's my feeling, my gut feeling. Okay, so let's go to the next one, and that is Mohnish Pabrai with his Pabrai investments. And here you can see this is separate from his global portfolio. These are only his US-based stock equities. He has a bunch of international stocks and a whole nother portfolio in Turkey, India, and all sorts of other countries. So we're only looking at his US portfolio here. And so you can see that he didn't add any more to Warrior Met Coal, but that's still his biggest position. And Warrior Met Coal, like I've mentioned in previous videos and posts on X, and if you don't follow me on X, please follow me on X, that Warrior Met Coal has so many tailwinds behind it. After the earnings, they jumped up to over $80 per share. Right now, they're around $80 per share, but there's been a drop in the overall market, so they've been hit a little bit by that, but still up tremendously. So Mohnish has 34% of his US portfolio in Warrior Met Coal. And then what stuck out to me here is his second best holding, AMR. He added 15.57% to that. And I've been looking at AMR more and more, and I posted on X about this, but they seem to be pretty good. They posted a net loss for this last quarter, but once the met coal industry picks up, they should be posting larger and larger revenues and larger free cash flow from that, the increased revenues in the higher selling price of met coal on average per short ton. And the difference between HCC and AMR is that AMR will run much farther than HCC. HCC is the safe, lowest cost curve play that will weather any storm when the met coal industry is in the doldrums. But AMR can survive that as well. They're a little bit higher on the cost curve, but when the market does turn, when the industry does pick up, AMR will fly. And it will definitely be a multi-bagger at some point when the met coal prices recover. So that's what's interesting to me about AMR. And the management specifically does stock buybacks. And they are sitting on about another $400 million in stock buybacks that are authorized, that are in the authorization that they had in 2023. At $1.5 billion, they've already bought back $1.1 billion of stock. So another $400 million of stock, AMR stock, being bought back in the next 1 to 3 years is going to make a huge difference in the EPS numbers for the company and the actual stock price for the company. And then another thing that I saw on his portfolio is that he added rig. Now this one I'm not too sure about. I would have to do more research on this and to see what he sees in rig. Right now, my play is Tidewater. And Tidewater and rig are separate. They're not competitors. Rig does drill ship drilling, oil drilling. And Tidewater supplies the ships to the oil rigs, to the major oil companies that are doing offshore drilling. So they're not the same. And they're not competitors in the space. I would choose Tidewater over rig, but again, I would have to do more analysis to see what he sees in Transocean. Now, the last super investor I want to go through is Third Avenue Management and their fund. And they also do a basket of many stocks, which is not my investment style. But why I'm interested in looking at their portfolio and their changes is because they invest in a lot of the same things I do. So their number one holding here is Tidewater. And that's a name that I've been trying to get into and concentrate more. And recently they had their Q3 earnings and they went up after that, $5 to $10 up over their existing price before earnings. So that is a name that I'm trying to concentrate into. And if it falls down to closer to $50 or $51, which is my average cost, I'm going to be buying more of those shares. And you can look at my previous videos on Tidewater to get the full investment thesis. I recently did one this week or last week about Tidewater, so check it out here. And then their second position is HCC. So two of their main two positions are some of my biggest positions. So HCC, you know the story and thesis behind that. I also have a video on that. You can check that out here. And these names I talk about a lot in my X account, so please follow me there so you can get up-to-date and real-time information about these stocks and stock analysis. Other than that, they have Valaris. They reduced that a little bit, and they really added to Skyline Champion Corp. That's not something I am interested in buying, so I just wanted to note that they bought that. They also bought a new position in BCC and ROG, and these are companies that I am not familiar with, so I'm not going to be talking about those or covering those right now. And those are the major changes here that I am interested in covering. I don't really see any other themes here in their changes or activity to their fund. So I'm just going to leave it at talking about Tidewater and HCC. Valaris, they changed a little bit. Valaris is also owned by Mohnish and his fund, but that's not a name that I'm really interested in buying. And that's it, guys. I covered 5 different super investors, what changes and activity they had in their funds. Some of those funds I agree with, some of them I don't. Rotating out of tech and AI just because of some AI overspend or AI capex overspend is not really a reason to rotate completely out of a AI name. Like some of these funds removed and reduced their Google, Amazon, Microsoft, and Meta holdings. And that's not something I really endorse because you never know when the AI capex will match up with the actual return of revenue coming from that AI capex spend. So you don't want to try to time that and try to get that right by timing the market. So I always endorse a long-term approach, holding your assets, investments. If you have high conviction and you know that they're great compounding machines, hold on to those investments for years and years and years, and you will get a great fine result if you do that. But you have to make sure that you do your due diligence and get the highest quality companies, not the hype machines, not the things that are just going up in the moment. But you have to look at fundamentals, you have to look at their key metrics, you have to look at their fair value, you have to do DCF models, you have to read their 10Qs, all of this other financial information about a company, make sure that the fundamental analysis is intact, their moat is intact, they cannot be disrupted for years and years and years, so they can have time to compound that wealth that you invest into them, and just make sure that you're making an overall sound and reasonable judgment on an investment. So that's what I always endorse, and that's how I feel about every single name in my portfolio, my highly concentrated portfolio. But that's it, guys. If you like this content, please like and subscribe, and I will see you guys in the next one.